All right, strap in everyone, because today we are going deep, deep into UAE taxes.
Deep dive time.
You want to know. How is taxable income even figured out here in the UAE? Well, we gotcha. We went through this UAE Federal Tax Authority guide.
Oh, yeah.
A big one, let me tell you.
It's a hefty document.
Hefty, and we are going to break it down for you.
It's great, though. It's actually
Yeah.
really practical. Lots of examples and case studies. So
Yes.
it's not just theory, but how it actually works.
Exactly, and that's what we're all about, right?
Yeah.
Actionable information you can use.
Mhm.
Okay, so first things first. UAE corporate tax law.
Yes.
It's been in effect for a little while now, right?
That's right. Since June 1st, 2023.
Okay.
For any tax period starting then or after.
So if you're just tuning in now, no worries.
You're not alone.
It's all good.
Yeah.
Okay, so basics, who does this apply to?
Okay, so basically anyone running like a regular business in the UAE, making money, you're probably what they call a taxable person. Freelancers, entrepreneurs, big companies, everyone.
Okay, so not just the big guys.
Nope.
Okay, good to know.
Mm-hmm.
So once you've figured out, all right, I'm in the taxable zone,
Yeah.
what's the next step?
Well, you got to figure out like your accounting method.
Okay.
There are two main ones, accrual basis and cash basis.
Okay.
So accrual is all about when you recognize income and expenses when they're earned or incurred.
Right.
Even if you haven't like seen the money yet.
Okay, so more for this sophisticated business.
You could say that.
Yeah.
And actually, if your revenue is over 3 million AED, you have to use accrual.
Okay.
But if you're under that, you can use cash basis, which is just when the money actually hits your account.
Easy peasy.
Yeah, much simpler.
Okay, so choose your fighter,
Yeah,
depending on your business.
exactly.
Comfort level.
Yeah.
Okay, so you've nailed that down. What's next?
So next, you got to determine your tax period,
Tax period.
which is usually like aligned with your financial year.
Okay, makes sense. Keep it consistent.
Yeah.
Now, let's talk about
The fun stuff.
exemptions.
Everyone's favorite.
Because who doesn't love a tax break?
Exactly. So the guide actually lists several types of income that are, surprise, exempt from corporate tax.
Okay, hit me.
All right, so first up, domestic dividends.
Okay.
Dividends you get from other UAE companies, tax-free, designed to keep that investment flowing within the UAE.
I like it. Okay, what else?
Then there's the participation exemption. This is about encouraging international investment.
Okay.
So income from certain foreign investments that you hold can actually be exempt from UAE corporate tax.
Really? Even if it's from outside the UAE?
Exactly, but there are a few conditions.
Okay, there's always condition.
You need at least 5% ownership in the foreign company. Got to hold it for at least a year.
Okay.
And that foreign country needs to have a tax rate of at least 9%.
9%. Okay.
Yeah.
So not a total free pass, but...
Right.
Oh,
Definitely opens some doors.
it does. Okay. And then...
And lastly, the foreign permanent establishment exemption.
What's that?
So this one prevents you from being double taxed if you're already paying taxes in another country.
Okay.
On those activities, as long as their corporate tax rate is, again, at least 9%.
9%. I'm sensing a theme.
Yeah, it pops up a lot.
It does. Okay, so...
But important note,
Yes.
expenses related to these exempt incomes, they're usually not deductible.
Oh, okay.
Got to keep it balanced.
You win some, you lose some.
Exactly.
Okay. So let's move on to the stuff that we can deduct.
Right.
I'm all about
Maximizing.
those tax savings.
Yeah.
What's the general rule?
So the general rule is that your expense has to be like wholly and exclusively for business purposes to be deductible.
So I can't try to sneak in that new TV as a business expense,
Probably not.
even if I'm doing market research.
I don't know about that one.
Okay, all right.
But there are some interesting things, like even if you give your employee a company car that they use personally, that's still deductible
Interesting.
because it's considered part of like attracting and retaining talent.
Okay, so it's really about the intention
Right.
behind it.
Yeah.
Okay, I like it.
Mhm.
Now, are there any specific types of expenses that people tend to trip up on?
Definitely. One of the big ones is distinguishing between capital and revenue expenditures.
Oh, yes. Explain this one to me like I'm 5.
Okay, so imagine you buy like a fancy 3D printer for your business.
Okay.
That's a capital expenditure, a big investment with a lasting benefit.
Okay.
You can't fully deduct that right away,
Okay.
but the filament you use to make products with that printer,
Yeah.
that's a revenue expense, day-to-day cost of doing business, so that's fully deductible.
It's like Planting a tree, you can't deduct the whole tree
Exactly.
right away, but you can deduct the water and the fertilizer.
Exactly.
I like.
And another interesting thing, like pre-incorporation or pre-trade expenses, like the money you spend getting your business off the ground, that can actually be deducted in your first tax period once you're up and running.
Oh, good.
So that initial investment doesn't just disappear.
Yeah, that's a relief.
Yeah.
Now, what about the expenses that are like absolutely not?
Oh.
Red flag, no-nos.
So donations, for example, they're only deductible if they're to officially recognized charities, you know?
Okay, so be smart about your giving.
Exactly.
All right, what else is on the naughty list?
Fines and penalties.
Okay.
Big one. Unless they're specifically for, like, compensating for damages.
Oh, could
So no speeding tickets.
Right, got it.
And obviously a bribe's completely off the table.
Makes sense. Just be a good citizen.
Yeah, follow the rules.
All right, what else?
Let's talk about dividends.
Okay.
Dividends paid to owners, not deductible as an expense.
Got it.
Got to keep things fair.
Okay.
Then there's input VAT, if you can recover that, meaning get it back from the federal tax authority. You can also deduct it.
So no double dipping.
Exactly.
Got it. Okay, last one.
Okay.
Private pension funds.
All right, so you can deduct contributions you make as an employer, but only up to 15% of your employee's total pay.
All right.
And importantly, these contributions have to be paid out within the tax period.
Okay.
So you can't, like, stockpile them to get a bigger deduction later.
Wow, they really thought of everything.
They did. It's a pretty comprehensive guide.
It is like a tax detective.
Yeah.
All right, well, lucky for you, dear listener.
We're not done yet.
We're just getting started. Stay tuned as we continue our deep dive into the wild world of UAE taxes.
It's going to be a wild ride.
Okay, we're back and ready to tackle some of the more complex but oh so important parts of UAE corporate tax.
The meaty stuff.
The meaty stuff. Let's talk about interest expenses.
Okay.
They seem straightforward.
Yeah.
But yeah, taxes never are.
You're telling me.
So what kind of limitations are we talking about here?
Okay, so there's this thing called the General Interest Deduction Limitation Rule.
Okay.
It sounds a little scary.
It does.
But it's really meant to, like, prevent companies from going crazy with borrowing just to reduce their taxes.
So it's like a safeguard.
Yeah, exactly, like a safeguard.
Against aggressive tax strategies.
Yeah. Okay, so how does this actually work?
So basically there's a cap on how much of your net interest expenditure you can deduct each tax period.
Net interest expenditure. Remind me what that is again?
Right. So that's basically the difference between your interest expenses and your interest income.
Okay.
So you've got loans, you're paying interest, but maybe you also have some investments where you're earning interest. So net interest expenditure looks at that overall impact of all that.
Got it. So what's the magic number?
Okay. So your net interest deduction can't exceed 30% of your adjusted EBITDA, or 12 million AED, whichever is higher.
EBITDA.
Yeah.
Another one of those acronyms that...
Makes me feel like I need to go back to business school.
Don't worry. EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Oh,
But basically, it's just a way to gauge your company's profitability from its core operation.
So it's like peeking under the hood.
Exactly.
Seeing how the engine is really running.
Exactly. And the guide has a very clear formula for calculating your adjusted EBITDA.
Okay.
It takes into account depreciation and interest income or expense related to certain types of projects.
Okay, so back to this general interest deduction limitation rule. If I go over that 30%, or the 12 million, what happens? Am I just out of luck?
No, not necessarily. You can actually carry forward that excess interest expenditure to future tax periods up to 10 years.
Oh, okay.
So it's like a rainy day fund.
Okay, so it's not a total loss.
No.
Just a delayed deduction.
Exactly.
I could live with that. Okay, you mentioned a specific interest deduction limitation rule.
Right. So this one's all about keeping things fair, especially when it comes to related parties.
Okay.
So, like, imagine you loan money to your brother's company at a ridiculously high interest rate. Just to lower your own taxable income? Not cool.
No, not cool.
Exactly. So this rule disallows deductions for interest on loans from related parties that are used for certain things, like paying dividends or buying back shares.
So keep it in the family, but keep it
above board.
Above board, exactly. All right, now let's switch gears.
Okay.
Talk about the dreaded L word.
Uh-oh. Losses.
Losses. What happens when that happens?
Okay, so tax losses, not fun, but the UAE system has some ways to help you out.
Okay, tell me more.
All right, so first, what is a tax loss? It's basically when your deductible expenses are bigger than your taxable income.
Ouch.
Yeah, not a good place to be. But the good news is you can carry those losses forward.
Okay.
And use them to offset future profits.
Okay, so even if I have a bad year, I could use it to lower my tax burden later.
Exactly. But of course, there are some limitations.
Okay, of course.
You can only use those carried forward losses to offset up to 75% of your taxable income in a given year.
Okay, so not a total free pass, but
Right.
still helpful.
Definitely. And there's also a provision that allows companies with at least 75% common ownership to transfer tax losses between each other.
Oh, that's interesting.
Yeah, so if one company in a group is struggling, another one that's doing well can help out.
Okay, so it's like teamwork, but for taxes.
Exactly.
Now, what happens if, like, ownership of a company changes? Do those losses just disappear?
That's a great question, and the guide actually addresses that. So if there's a major change in ownership, we're talking more than 50%,
Okay.
those tax losses from before the change can't be carried forward.
So it's like a reset.
Yeah, like a reset.
Okay.
It prevents companies from buying and selling businesses just to, take advantage of past losses.
Got it. Okay, so all this talk about losses is making me think about taxes I might have already paid in other countries.
Yeah.
Is there any way to, like, avoid being double taxed on the same income?
Absolutely. That's where foreign tax credits come in.
Okay.
So if you paid taxes on income in another country, that's also considered taxable income in the UAE. You can claim a credit.
Okay. Sounds good. What's the catch?
So the credit you can claim is limited to either the actual foreign tax you paid or the UAE tax due on that same income, whichever is lower.
Okay.
So it's not a full refund if you paid more taxes abroad.
Got it.
But it definitely helps offset the burden, and any unused foreign tax credits can't be carried forward or back.
Okay, so use it or lose it.
Exactly.
Okay. My head is spinning a little bit,
It's a lot of info.
but I'm feeling more confident about this whole thing.
That's good. That's the goal.
It is. Now, what about non-residents doing business in the UAE?
Right, so that adds another layer.
It does, yeah.
But the guide actually does a good job of breaking down how a non-resident can be subject to corporate tax here.
Okay, so what are we talking about here?
So the most common scenario is having a permanent establishment in the UAE. This could be like a physical office, a branch, even a construction site that lasts for a certain period.
So if I'm like a European company and I open an office in Dubai, I'm going to be subject to UAE corporate tax.
Exactly. And it's not just about physical locations, even if you don't have a traditional office, but you have employees working remotely in the UAE for a while, that could also be considered a permanent establishment.
Oh, wow. So it's really about the activities
Yeah.
and where they're happening.
Exactly.
Okay. Are there other ways a non-resident could end up being taxed?
Yeah, so the guide mentions deriving income from immovable property located in the UAE, like renting out a building you own.
Okay. So even if I'm not running a business here, just owning property.
That's right. And lastly, if you're providing services in the UAE, you could also be subject to corporate tax. It's all about where that economic activity is happening.
Okay, wow, we've covered a lot.
We have.
But thankfully, this guide also has a bunch of case studies.
Yeah, that's great.
That really put all these rules into practice.
Yeah, real-world examples.
Should we take a look at a few of those?
Let's do it. I think that's a great idea.
Awesome. So let's shift gears and dive into some case studies to really demystify this whole world of taxable income in the UAE. Okay, so we've gone through a lot, exemptions, deductions, those interest expenses, tax losses, but now it's time to see how it all works.
Yeah.
In real life.
Case studies?
Case studies, they're like those light bulb moments where it all comes together.
Exactly. You can read the rules all you want, but seeing them in action, that's when it clicks.
It's like watching a cooking show.
Yeah.
You know, you can read the recipe.
Yeah.
But seeing them actually make the dish, that's what makes it all come alive.
That's a great analogy.
All right, so let's dive in, see what culinary masterpieces await us in the world of UAE taxes.
Okay, case study 1, this is a good one.
Okay.
Really gets into those deductible, non-deductible expenses.
Okay.
And they use a healthcare company as the example, which I think is really smart.
Oh, interesting.
Because it's something everyone can relate to.
Healthcare.
Yeah.
A universal need.
Yeah.
Just like understanding taxes.
Exactly.
Okay, so tell me more. What's the setup?
All right, so picture this. We've got this company, let's call them MedCorp.
Okay.
They've got a mix of expenses, cost of goods sold, salaries, rent. The usual stuff.
The usual suspects.
But then they also have some interesting things like donations to a charity.
Right.
Fancy client dinners, golf outings, even a few speeding fines from their sales reps.
Oh, I'm sure we've all been there.
Yeah.
So how does the case study break it down? What's deductible, what's not?
Okay, so those charitable donations, remember we talked about how they have to be to qualifying organizations?
Yes.
This shows you how it works. MedCorp made a donation, but the charity wasn't officially registered as a qualifying public benefit entity.
So, good intentions, but missed out on that deduction.
Exactly. Got to do your research.
Yeah, be strategic.
Be strategic with your giving.
Okay, what about those speeding fines? Any luck there?
Nope. No deduction for those fines and penalties. Generally not deductible unless they're compensating for damages.
All right. Got to follow the rules.
Speed limit.
Speed limit, yeah.
Okay. Now, those client dinners, golf outings, that's always a bit of a...
Yeah, gray area.
Gray area. Right. So the guide actually clarifies this. Only 50% of entertainment expenses are deductible.
Okay.
Recognizing that there's often a personal element to these things.
So it's like they're saying, we know you're not just talking business.
Exactly.
There's some fun mixed in there.
Okay, I appreciate that. The realism.
Yeah, being practical.
Now, this case study also highlights that difference between capital expenditures and revenue expenditures.
Oh, yeah, good point.
Back to our 3D printer.
Yeah.
So remind me, how does that work?
All right, so MedCorp invested in a new piece of medical equipment, right?
Okay.
That's a capital expenditure, big investment, lasting benefit. You can't deduct the full cost all at once.
Okay.
But you can deduct the depreciation over time. So spreading it out.
Yeah, spreading it out.
Okay, makes sense.
So understanding those nuances is key.
All right, so case study 1. Lots of good stuff in there.
Yeah, very practical.
What else do we have?
Okay, case study 6. This one's great for smaller businesses, freelancers.
Okay.
It goes into the cash basis of accounting.
Oh, yes, cash basis. When the money actually moves.
Exactly. Nice and simple.
All right. Who are we following in this one?
Okay. So we've got a consultant. They have income from different sources, client payments, some late payments, even some advance payments for services that I haven't even done yet.
The life of a freelancer.
I know, right?
So how does the cash basis affect their taxes?
So with cash basis, it's all about when you actually receive or pay the money.
Okay.
So even though they got some income in advance, it's still taxable in the year they received it.
Interesting. So very different from accrual.
Very different.
And this case study walks you through some of the rules specific to cash basis.
Like how capital expenditures are treated?
Right, because with cash basis, they can deduct the full cost of those assets right away.
Exactly. One of the perks.
Yeah, keeps things simple.
Simplifies everything.
All right, 2 case studies down. I feel like I'm becoming a tax expert.
You're getting there.
But there's more, right?
There's always more.
So we've talked income expenses, but what about when those expenses are related to things happening outside the UAE?
Ah, yes. That adds a whole other layer.
It does, especially for businesses that are international.
Exactly. Cross-border stuff can get tricky.
It can. So, thankfully, the guide addresses this, right?
It does. And one of the best case studies focuses on the foreign permanent establishment exemption.
Oh, right. The one that prevents double taxation.
Exactly. So you're not paying twice on the same income.
Like a passport for your profits.
I like that.
Okay, so this case study 7B, tell me more.
Okay, so we have a company based in the UAE, but they have a branch office in another country.
Okay, I'm picturing a fancy office in a cool city.
I know, right? So the key here is documentation is crucial to prove the income and expenses related to that foreign branch.
Makes sense.
Because remember, the exemption only applies if that branch is taxed at a similar rate to the UAE.
Right, that magic 9%.
Exactly. So what kind of documentation do they need?
Yeah, what are we talking about?
Separate financial statements for the branch, intercompany agreements, proof of foreign tax payments, the whole 9 yards.
Wow, they really want to make sure you're not trying to pull a fast one.
They do. It's all about transparency.
Transparency and record-keeping, key takeaways.
Absolutely. Being organized pays off.
It does. Okay, case study 7B, definitely one to remember. Any others that come to mind?
Yeah, case study 12 is interesting. It tackles transfer pricing.
Oh, yeah, transfer pricing, always a hot topic.
It is. So this involves a UAE company selling goods to a related party in another country.
Okay, so basically making sure they're not manipulating prices to avoid taxes.
Exactly. And the case study shows how the UAE rules prevent that. It's all about using arm's length pricing.
Arm's length meaning?
Meaning the prices should be the same as if they were dealing with an unrelated company.
So no funny business.
No funny business. Keep it fair.
Fair, transparent. That seems to be the theme here.
It is. The UAE tax system is all about that.
It is. I feel much more comfortable with all this now.
That's great to hear.
But I'm sure there's always more to learn.
There's always more.
So where should our listeners go from here?
Well, this